All right, welcome to the Monday edition of the On the Tape podcast. I'm Dan Nathan. I'm joined by Danny Moses and Liz Young-Thomas. She is the head market strategist at SoFi. Welcome, peeps.
Good morning.
Good morning.
All right, Guy Adami is in parts unknown. I literally mean he's in parts unknown. We cannot even dox him because he's away and we don't know where he is. And I asked his son today, doesn't know where he is, but that's fine. Hopefully Guy is having a good weekend there. We got four things to do today. We got to go over a little bit about what happened in that October jobs report. We're going to talk, obviously, about the U.S. Federal Reserve. They are meeting this week. There's a very high probability of a 25 basis point cut. We're going to talk some single stock stuff, some earnings, and obviously the election. And I'll just say this, Danny, this might be something that resonates with you. The distance to the end is closer now than it's ever been. Are we going to get you see what I did there? Are we going to get the upper hand on this market, on the election and the like here? Liz, let's first start with Friday's jobs report. It came in at a minuscule, I want to say 10,000 or so. That was down from an expectation of 150 or so. And from last month's 254, which was revised a little bit lower. We know it was the private employment market that might have been skewed by the hurricanes and by the Boeing strike. So what was your takeaway of that? And does it change your view of the U.S. economy right here?
So the numbers themselves were we added 12,000 non-farm payrolls in October. The expectation was for 100,000. So that was a really big miss. But the unemployment rate stayed steady at 4.1%. And that seems to be the thing that people watch the most. So it didn't scare anybody. And what I had thought before is exactly what came true in the sense that even if this is way off of expectations, it's going to be explained away by hurricanes. It's going to be explained away by strikes. So people are just committed to not seeing this as a bad sign. I think it's probably in this particular instance a little bit true that we have to just wait this one out, wait for the next data, and maybe more importantly, wait for the revisions, which take a couple months to come in. The revisions this time were also downward. So the number of jobs that we thought were added for the prior 2 months were less than. So again, disappointing, but nothing that has been alarming. So to answer the question very directly, does it change my view of the economy right now? No. But I do think that this report was a bit of an anomaly because of some weird stuff that happened through September and October.
Yeah. So Danny, when you think about that number, you think about expectations, market rallied off of it. Why? Because the certainty of a rate cut on Thursday after the Fed meets is now 98%. It moved up a little bit. So obviously a near certainty. And then you saw the December meeting, the probability of a 25 basis point cut also moved, higher to about 82% or so. So when you look at a number like that, it kind of supports the case for the Fed to continue to cut rates, which is supportive of an economy that some folks think is weakening, made evident by that October jobs report.
Yes, I mean, spending by the consumer is still pretty strong. GDP came in still pretty strong. I don't think a monthly number on the jobs number that Liz was just talking about, breaking that down, does anything to kind of change the narrative. The Fed's going to be 50 basis points from now to year end. I just want to make people note that because of the election, the Fed meeting actually decision is Thursday this time instead of Wednesday. I know that happens every once in a while. I just wanted to point that out. So no, I think what companies are telling us with earnings, I think the mosaic is still pretty much really, in place here. The consumer keeps spending. Companies are finding a way to earn around all of these issues. And I look at the companies individually on a bottom-up basis to make these investment decisions. And the macro is certainly important, but it's just noise because all these revisions that we continuously see, month to month. And so I think we're pretty clear that inflation actually may have not slowed to the point now that people want it to. And that's the one thing that I'm going to watch now is really the inflation numbers as part of the economic landscape more than anything, because again, we've seen inflation come down, but not to the level. I think it stopped going down to the level that people are going to get comfortable with. So.
Yeah, so it's interesting that you mentioned the consumer. They continue to spend despite the cumulative negative effects of inflation, which has come down considerably over the last 2 years or so, from 9% down to this 3% bound. But when you think about, you just mentioned, on the individual stock level, Carl Quintanilla tweeted this out this morning from Deutsche Bank. Earnings beats running well above average. 78% of S&P 500 companies have beat on earnings by an aggregate of 7.1%, well above the historical historical average of 4.9%. Liz, we talk to our main man, John Butters, all the time. He is a senior earnings insight analyst over there at FactSet. He often remarks how earnings estimates come down over the course of any sort of quarter. And so, yeah, some of these beats that you see that are above like the 5-10-year averages or so, oftentimes they come in line where the consensus was, let's say, a quarter or two ago. But this seems far greater as far as the magnitude of the, the beat, but also the amount of companies in the S&P 500 that are beating.
Well, I think there's two things going on here. The first of which is what Danny just mentioned. The consumer is still spending. And I think that has actually surprised companies. I think, frankly, it's surprised economists. It's surprised a lot of people. It's even surprised markets. So as we continue to see personal spending come in strong, personal income come in strong, but without the pressure of wages continuing to go up and affecting inflation, I think that's been a positive that nobody's really expected to be quite as big of a positive. So that's helping companies' revenue line. The other thing that I think is going on here is that despite the fact that all of this macro data seems to continue to come in solid and there hasn't been anything terribly concerning, the vibe check on just regular Americans and the vibe check on CFOs and CEOs is that they've been cautious because they don't feel like they have as much visibility as they normally do. Rate expectations have changed so quickly and so much throughout this year. Yields have moved so much throughout this year. Obviously, we're on the precipice of a U.S. election. There's a lot of uncertainty that has plagued markets and plagued capitalism, frankly, for the whole year. So I think CEOs and CFOs have done a good job of forecasting in a conservative way, which has had expectations lower than maybe they would be if they were super optimistic. So beating those expectations has been easier. The last thing I'll say about this is what we've learned in markets over the last handful of quarters, though, is that in order to really get rewarded in your stock price, you got to beat by a lot. You have to be pretty exceptional in order to get that rewarded by the markets. Because now as investors, we expect beats. We expect companies to come in and show growth, particularly in technology. So the bar has just risen for how much the stock price is going to move on those results.
Yeah, and I guess, Danny, when you think about the potential for inflation to move higher, we know that inflation expectations are moving higher depending upon how far you look out. And I see four things in the offing that actually could reignite. Obviously, this rate cutting cycle. You also have the Chinese, which have been, stimulating their markets, right? And so the Fed, I think they're meeting this week in Beijing, and they're expected to announce another bit of fiscal stimulus. And so that could be inflationary. OPEC just said they are pushing out, production hikes. That could obviously be inflationary if you have the Chinese with their stimulating their economy. You see crude oil up a couple bucks here, right? And so maybe that's the sort of thing. And then obviously the U.S., no matter who wins this election, you either have tax cuts, right? That could be inflationary, or you have deficit spending, on the fiscal side, that could be inflationary. So Danny, when you think about all those things combined, it is a difficult task to consider how low inflation might be able to go towards the Fed's 2% target, because there's a lot of things out there that could serve as tailwinds to inflation.
Yeah, you just mentioned oil, and I think that's been a huge factor for the U.S. consumer as well. Certainly something to keep an eye on. We've rallied from 67 to 71, as you mentioned, on OPEC, cutting back their production, 2.2 million for the rest of the year. They just extended it a month, by the way. So it's not a huge deal, but again, sending a signal to the marketplace. And again, the only way you can get out of this debt deficit is inflation. You have to actually inflate it away. So that's kind of a problem, right? Both ends. And Liz's comment, about companies' earnings, and your comment, Dan, about beating, you really do have to beat and guide up when your overall market is trading at 22 times earnings. And you better be guiding up, I think more importantly, what you're saying in the future. You could potentially get away with maybe not beating as long as you raise to talk about the future. So we've talked about this market being priced to perfection to a degree. It's really amazing to me what investors want to have faith in and believe in, what they don't. But sometimes you get punished for being really honest in the marketplace as a reset. But those companies that are honest are the ones you want to own over the longer period of time, where you don't get caught up in selling at the bottom of a bad quarter potentially, and then buying at the top of what might not be a realistic forecast. So again, very important to understand management of these companies and kind of their guidance here, and whether they're truly meeting this type of guidance. So
Yeah, and I guess, Lilly was a great example last week. This is obviously, one of the largest players in GLP-1s. It's been a massive story. This was, nearly $1 trillion market cap at its highs, and they had its disappointing sales outlook. The stock cap down nearly 15%. This was last Thursday, I think, or Wednesday, and it made up a lot of those losses throughout, the day, and closed down 6% or so. But it's kind of shoot first, ask questions later. Liz, when we came into this year, into 2024, we were looking at expectations for double-digit earnings growth, I think 10, 11%, and then in 2025, 13, 14%. It looks like we're going to hit double-digit earnings growth in 2024, and we haven't seen 2025 estimates come down materially. So you have a S&P trading at 21.5 times, which seems high on a historical basis, 5 and 10 year. I think it's, high teens or something for both of them. But, when you have these, kind of secular moves as far as, generative AI and some of this other stuff that we're expecting maybe on the fiscal and monetary front, does 21.5 times seem reasonable as long as next year we're still staying, put with this 14% expected earnings growth?
Well, the way the math would work is if we had earnings growth that did come in the double digits again in 2025, even if the market didn't move, the multiple will come down. So it might actually look more rational. If we don't have another 25% year in the S&P, let's say we have a normal year in the S&P where earnings growth actually outpaces the growth in returns in the S&P, you'll see a natural compression of the multiple. So maybe we end up in the high teens, and then people will feel better about that. I do think that we are priced quite frothy, but that being said, we have been for a while, and we keep sort of worrying that just because it's high, it has to come down at some point. And this goes back to that Goldman note from a couple weeks ago, where market concentration seems to be the biggest risk here, that the multiple is high, much of which has been driven by just a handful of companies. And that concentration makes us so much more reliable on the multiple staying high in those particular companies. So if those companies give it up, then the whole thing starts to come tumbling down. The issue with that is that given why it's happened, the AI theme and the optimism around it, and the fact that now we are seeing little glimmers of companies actually producing some results because of AI, it doesn't necessarily have to end just because it's high. And I think anticipating that, particularly, I'll just speak for myself, anticipating that it has to end just because it's been going on for a while is not a good way to run a portfolio. And that's something that I fell victim to probably for most of this year, thinking, you know what, this feels like too much. It feels like too much. We should pull back. And it just hasn't happened. So I think we have to keep ourselves open to the possibility that even a concentrated market that feels a little bit out of whack can continue for a long period of time, especially when we don't feel like it's entirely rational.
Yeah, and we got to go back to this because you just mentioned the concentration of these names. You have an S&P that's up 20% on the year to date, obviously, and the NASDAQ composite up 21%. Apple, after its results last week, which were disappointing, I don't think expectations were particularly high. Apple's up 16% on the year. Microsoft, after a slightly disappointing quarter, is up 10% on the year, right? So we're starting to see, Google is basically in line. Amazon is outperforming, good quarter. Guide was great, and the stock moved higher. But, Microsoft, one of the largest market cap companies in the world behind Apple and NVDA, some of the stuff that they reported as far as their cloud business was, they say they're capacity constrained and they're going to continue to spend at a high pace. But at some point, if they just have less demand, the capacity that they've built might be too high, and the spending rate, may just kind of weigh on the stock. I think it's weighing on it right now. And so I guess the question, Danny, you have NVIDIA in a few weeks, November 20th. Like we say this every quarter for the last 6 or so, this is going to be a big macro event. The one quarter where they finally kind of, issue guidance that's below the street, that's the sort of thing, Liz, that could put it in the penalty box. So, Danny, I'm just saying, we have a lot of things. We're going to get to election in a second. It seems like there's so many massive events in the next few weeks. Where do you place NVIDIA as far as this secular trend? Because I'll just bring it back to Lilly for a second. I don't think anybody had it on their bingo card that company was going to miss sales the way they did. So sooner or later, we're going to have one of those in the generative AI trade. And if it comes from NVIDIA, it's going to be lights out for at least a few months, maybe a couple quarters.
Listen, it's the law of large numbers. And just back to the comment that Liz made about the U.S., markets trading where they do. It's still the sexiest game in town. It's supply and demand. And because of the way the market structure is set up, a lot of passive funds that are out there, it's self-fulfilling that money will go to the large liquid names. So let's just establish that right now. When you look at super micro, which I'm not going to associate with any other company potentially within the AI space, but it certainly is a wake-up call for a participant in the space that may either be potentially a bad actor, which may indeed be over-ordering or inflating order expectations. And people read through a lot of different things. So we are now reaching a point, to your point, Dan, this NVIDIA quarter is going to be hugely important once hopefully we get through the election noise and this Fed meeting and people focus on it. But you better, to your point you made earlier, you better beat and you better guide up, which I probably expect them to do. But at some point, I remember, I talked about this a lot in 99 and 2000. There were companies that were still beating and guiding higher, and the stock started to drop. I always cite JDS Uniphase as kind of the fiber optic poster child. And again, it's only because everybody's already there. It's a law of large numbers. And when the stocks start to come in, what is the buy point on those names that traded those? That's it. It's just, and so it really becomes, pay attention to price and your positioning on these names, and don't fall in love with stocks. Don't fall in hate with stocks at the same time, but from a short perspective. So that's kind of how I would look at it.
Yeah.
I have a question though. When that started happening, where did the money go? Did it go somewhere else in equities, or did it go to bonds?
It went
Somewhere
actually up.
entirely.
It went up in smoke because when you had like literally the Nasdaq closed down 30% in 2000, and the S&P closed down a little less than 10%. And when it was all said and done, I mean, the Nasdaq, you could have, Danny's point about the buy point. I know plenty of people, portfolio managers, traders, who were just averaging down. They were like, holy shit, the S&P, was at an all-time high. It closed down 30%. Well, 01 was worse than 2000, and 02 felt like an absolute gut punch because we had 3 consecutive years, of this prolonged bear market. And that's the interesting thing, Liz, is like, if you lived through that, and then you got to the financial crisis, it happened so much quicker, right? The market was only down 1 year, which is 2008. Then fast forward to COVID, right? And then we had literally we didn't even have a down year, did we? 2020, we closed up, and 2021, we were off to the races. So we just had the quickest 35% decline in about a month or 6 weeks or something like that in the S&P, but it V-bottomed.
But what's very different about this, I will say, this time period, and we got a glimpse of it in August, where people started crying for the Fed to emergency rate cut 75 basis
That's
points
right.
because the market was down. What's different about this time period is the reliance on global central banking to bail us out of everything. And at some point, people will pay attention to the debt. They'll pay attention that the Fed can only control so much. The problem with this particular time period is if you ask for that and get it, it's going to reverse all this moves in inflation, and it will basically self-fulfill higher inflation. We won't even go there right now because it's not a long enough podcast. But my point is every time period is different. This one, I think, has the most interesting elements to it for sure. A lot of moving parts.
Yeah, but Liz, what do you make of, you hear a lot of folks say this, despite, that you had Paul Tudor Jones and Stan Druckenmiller talk about how weighted they are to treasuries, in their portfolio. So the idea that you think, we have to inflate this away, which Danny just mentioned. So that just means, we're going to have a lower interest rate regime. A lot of folks feel like we're going to have a much higher interest rate regime because we're going to have these inflationary pressures that are going to be long lasting, well after this COVID hangover. So thoughts on that, because the way that the treasury market or yields have moved over the last month is about as curious as I've seen as long as I've been in the markets and have been focused on it. The idea, to Danny's point, that people were calling for this massive rate cut, right? They were really worried about the economy. And then we saw some data that kind of made it feel okay. But 50, I think that they did in September, a lot of folks feel like it was way too much. And now here we have a highest probability that we've seen in a very long time that we're going to have another 50 over the next 2 months or so. So to me, it's about as clear as mud, and I'm just curious what your thoughts are on the rate moves and how much. I mean, listen, here's the other one. We're going to talk about the election, obviously, but let's say this thing is not settled for a while. Danny and I remember what 2000 was like. I mean, it took months, right, to settle the election. That's the sort of thing where the Fed is going to want to stay pretty easy.
Yeah. So first and foremost, I think they should have done 50 in September. I honestly think they probably should have started in July with 25 and then done 25 in September. But in order to catch up and send the right message, I think 50 in September was fine. I think there would be two different regimes or two different periods where we have to separate interest rates from yields. So what's happening right now that's odd is that we know the Fed is cutting rates. We know that they're on this trajectory downward, yet yields have gone in the complete opposite direction. So what I think could happen is if they continue to cut too quickly and we haven't gotten our arms around inflation, which we know this has been a risk for this entire cycle, if they continue to cut too quickly because something like the labor market is faltering, then you could see a reignition in inflation and see some problems there. It would require the consumer to pick up their slack, though. It would require the consumer to be spending. And I don't see that entirely happening if the jobs market is getting weaker. So there are a lot of different things that would have to fall in place in order for that to be the case. I still think inflationary pressures would mainly have to come from the commodity complex and mainly have to come from probably wage pressures. So there's a lot of data that we'd have to get in before that would actually occur. And then yields rising in this environment. I mean, that has been something that I think has surprised a lot of people, but apparently has not bothered the equity market very much at all. But I think as we get closer to, let's say, 4.5 on the 10-year and God forbid, up to 5 on the 10-year, the equity market will start to really feel that pain and move in the other direction. But I think, again, the oddity here is that we know the Fed is on a cutting cycle. Yields are moving in the opposite direction. And that's the stuff we talk about every single day. What you actually want to look at are inflation expectations. You can look at that in a number of different surveys, and you can look at that in something like the break-even rates. And we have seen a big rise in the break-even rates. And the reason that matters is because that's what the Fed watches for whether or not inflation has become entrenched. And if those break-even rates or those expectations for inflation go up and continue rising, that's when you have to start to expect the Fed to take a step back and say, you know what, maybe cuts are not the best idea right now. Maybe we should at least pause for a month or a couple months.
Yeah, Danny, and that brings us back to the year 2000 and 2001, when you remember, like we just talked about, in 2000, how much the NASDAQ was down, and, the popping of that bubble seemed fairly evident by the end of 2000. The Fed came in early 2001 and had that surprise rate cut. And really, it felt like to support the stock market, not really the economy. And they kept on cutting, but the stock market kept on going down, right? So at some point, talk to us a little bit about that, because we're going to basically have 100 basis points of cuts between September and December. And to Liz's point, at some point, the stock market, something's got to give. It either is the economy inflects, and we just saw that GDP print, right, that looked better than expected. I think it was 2.8%. Let's say we have the unemployment rate doesn't go up meaningfully. This is the sort of situation where maybe it's a bit of a Goldilocks scenario. We can say that because Guy's not on the pod right here. But again, if you thought that where, interest rates were going relative to the 10-year, and you said we're still kind of restrictive in this economy that's hanging in there, is it about the economy and the jobs market, or is it about risk assets?
Yes and yes. So I think this move that we've had in the 10-year yields have been kind of that we've gone from the 360 to 430 level. I know we're down a bunch today as we sit here right now. I think we're down from 436 to 428 or somewhere in that range. But I think a lot of the move has been economic growth, and people feel okay. The next leg, to your point, the scary part, 4.5% or 5%, maybe something completely different, more embedded inflation expectations, or God forbid, a term premium that people want. They're going to have to get a higher rate to take the risk on to own U.S. Treasuries, right? But we'll talk about that again. That's a whole nother podcast about our debt levels. And so, listen, we've been a prisoner. It's really started with Bernanke. We used to call it his precious with the stock market. So in 2008 and 2009, 2010, whenever there'd be a crisis, when I say crisis, the stock market dropped because of a Bear Stearns event or whatever, we would have Bernanke come out and do something, but he always reacted to the stock market itself. I don't think Powell is as bad. He hasn't relented to all those pressures. We saw that in August. He didn't kind of move like that. So I think it's a combination of, again, who your audience is, but more importantly, Dan, it's credit spreads. And credit spreads have been so tight here, even with the Treasury moves and the yields that we've had higher, right? It's actually tightened even more because the corporate credit and the private loan market, that stuff has not moved. It remains tight. So that's what I'm watching more than anything, because the functioning in the credit markets and the ABS markets, the ability to initiate and sell auto loans and credit card receivables and all these buy now, pay later, all this stuff, it's still working. If that were to back up because rates get to a certain level and or economic growth slows to a point where people start to question it, that's when you have a massive back in the system. And that's what the Fed's going to have to pay attention to more than just the stock market. So I know I went up, that was a long answer to the question, but there's just so many variables here to think about. But bottom line is, Dan, yes, when the stock market drops, people are programmed to look to the central banks and the Fed in particular to, quote, save them. And at some point, saving them promotes inflation, and that does not work. So.
Yeah. All right. Let's talk about the election here because, again, we're recording this Monday right after the market opened. And this was a very interesting weekend. There was a lot of movement, at least from a sentiment standpoint. That Iowa poll that came out is supposedly a very high quality poll, showed something about potentially like a shift for the Democrats, for Harris in particular. And, I think a lot of folks, on either side of the fence, if the Iowa poll, shows Harris in a lead, you could see a lot of stuff break that way. Clearly, blue wall and that sort of thing. And maybe it is a bit of a wave election, which would be crazy if you think about just how close the polling nationally is, right? And then it comes down to these prediction markets. And we talked a little bit about this on the pod over the last few weeks. Easily spoofed, right? And maybe the sort of thing that is trying to kind of make certain, or the electorate feel something about their candidate one way or another. Maybe it's to help set the stage for whoever wins, to make the case that, we'll look at the polls and look at the prediction markets and look at individual meme stocks and say, how could it be that this candidate lost, that sort of thing. So Liz, how are you thinking about just the change in sentiment in such a short period of time right before the election? Because I think a lot of folks, it's kind of like higher taxes if, you have Harris win, but really, over $400,000 in income. And when you think about how many people that the, higher taxes affect on the very high end, we're talking about low percentages of our 330 million people, right? And then on the flip side, you have lower taxes primarily going to large corporations, but large corporations also make up a very small percentage of the businesses here in the U.S. So I think they probably net themselves out. So curious how you're thinking, how you're gaming this out, and how you think the stock market and obviously yields are going to react to, let's say, a surprise Harris win at this point or a Trump win.
Well, okay. So first of all, let's go back to what happened over the weekend. It showed there was a Des Moines poll that came out. Apparently, the pollster who runs that is supposed to be the best in the business. It showed that Harris was ahead by about 3% in Iowa. The read through of that is then maybe she's ahead in all of the swing states by roughly the same amount, in which case all the betting markets moved to expect that. I wrote about deficits last week, changing the subject a little bit here now. I wrote about deficits last week. What gets frustrating for me about elections is we'll focus on one of the elements of it and not the other element. So we focus a ton on taxes, right? The expectation if Trump gets elected is that obviously the tax cuts will get extended. If Harris gets elected, maybe only part of them will get extended, and then taxes will be raised on the other part. The other thing that we have to remember, though, is both candidates are going to continue spending money. They're just going to spend it on different stuff. So the deficit problem doesn't get solved no matter who is in office. And this expectation of having to issue more treasuries in order to cover that deficit doesn't get solved either. So it's just a matter of how we get there. It's the different components of an equation that says, okay, spending's going to go up on both sides. Taxes may come down under one and not under the other. But if you offset it with more spending, we still have a deficit problem. So it doesn't necessarily change things all that much. The way that I try to think about elections, and I think we learned this the last time that we had a contentious election and the time before that when we had a surprise result, and even we learned it in Brexit. Polling going into the election is just not necessarily reliable. If you position your portfolio for what the polls say when the market closes on election day, you have, I would say, about a 50-50 chance of being completely wrong. And remember what happened the last time that Trump was running for president. The overnight markets were completely different from the live session that started the next day and ensued for the following days. So this close to an election, I would not be relying on a poll to position my portfolio and bake in who I think is going to win.
Yeah. Hey, Danny, when you think about just the movement here, and you think about the dollar weaker today on, Harris's prospects rising a little bit, you're probably going to see some stuff in some different sectors move around. And to Liz's point, 50-50 chance of being really wrong on the flip side of it. And you brought up Brexit, 2016, that election. There were some crazy moves. I think when Trump won, I mean, the futures in the equity market were locked down limit, right, overnight. And at some point, they just started rallying and kept on going. So when you think about the S&P, it's pricing in like a 1% move in either direction by Wednesday's close, which is kind of interesting to me. It seems a little bit light, and 2.5% or so by the end of the week. What are some of your expectations, maybe kind of baseline-ish, if we have a fairly tight election that's going to be contested for a while? Is that going to be the sort of thing that kind of ushers in just a new period of volatility? Because other than early August, and other than a few days in early September, it's really been bottom left, upper right for equities.
Yeah, so I think to the election on Tuesday night, I think we will know Georgia and North Carolina, which will maybe tell us a lot. So we'll get some type of clarity. We're not going to get everything. And as far as the House and the Senate, I think we may get a better picture on the Senate, but certainly not the House. So there's a lot up in the air. I think Trump brings a lot more geopolitical risk into the equation. Therefore, some of the assets that have been moving up into this, which have been gold and crypto, and obviously Bitcoin is part of that universe. And the dollar, obviously, to your point, Dan, is coming in today versus having strengthened. So it's PTSD, I think, where this has been going on now for basically 3 election cycles as we sit here. And so I obviously watch the banks. I think the regional banks are a big play into this and have been a bigger play than some of these other things that I've been watching. So I'm watching that, obviously. And treasuries, I honestly wouldn't be able to tell you if there was a near-term jerk reaction. If we had a real issue and chaos started to break out, you would think inherently that treasury yields would drop, and that's probably what will happen over time. But I think the market, it's interesting that it's pricing, what'd you say, a 1% move? That's basically it at this point. I think the bets have been made, and I know we're going to talk about these betting markets here potentially and what they've been expressing kind of into the markets. But I really focus on, there's not going to be tax cut extension, sorry, but people that believe that you're going to have, maybe you'll get an extension of it that's not going to have some type of repercussion are just dreaming, because at some point we have to pay for all this stuff. So all the promises that are made, and we're not going to tax overtime, we're not going to, it's just noise to me, because the reality is we have a fiscal issue no matter which party wins. And that's what I'm trying to focus on. And I'm trying to focus on owning the companies that are immune from that for the most part. And there are a lot of companies which have just been doing their business and insulating themselves from a lot of these things. And that's, to me, where you want to be focused on. I don't have that list in front of me, but this is good. Get your popcorn ready, I guess, for this.
It's interesting when you say the repercussions. I mean, a lot of the C-level suite here in America are holding off on certain decisions other than the generative AI, build out, the data center build out. I mean, those guys, we learned from their CapEx last week, they're going full force in one direction. And, I think regulating generative AI in general is going to be a bipartisan sort of thing. But Liz, when Danny just mentioned, we're talking about these prediction markets. Okay. So it's, Polymarket, it's Predicted, it is also Kalshi. These are getting a lot of attention, but these markets can be moved by, a handful of players. They don't seem particularly transparent. Supposedly there's a lot of wash trading going on there. You as a strategist are probably getting tons of questions about the polls and about this is the first time I remember so much emphasis has been placed on these prediction markets. How do you think about it? Do you think it's actually influencing investors and what they're doing in much larger risk assets?
I think that it's happening at a time when risk appetite is still pretty high and people are willing to have fun in a prediction market. We have a sort of betting mentality as investors broadly, betting on sports. This is, I believe, the first time that betting on the election has been legal. So it's just another way to express risk appetite and express this risk-taking behavior. So I guess I'm not all that surprised that it's happening. Do I think it has the power to actually move markets or change investor psyche? No, I don't think that that's happening right now. I think that this is something that people are doing on the margin for fun, and the rest of us are just sort of watching as some kind of exhibit.
Yeah, so we talk about all these gambling sites now that obviously take bets. Let's keep in mind that the CFTC tried to block the ability of anyone in the U.S. gambling on U.S. elections, and they were overruled by an appellate court. So just a few weeks ago, this Kalshi started taking bets, and I think they're up to 139 million total. That pales in comparison to the billions which have been wagered in the poly market over using crypto over in Europe. And Robinhood is now taking, Interactive Brokers is now taking, again, I think they're small and they're basic bets that are out there. I think this is what the CFTC kind of feared, but just keep in mind the lack of liquidity in the U.S. markets and how much it can move as kind of a predictor there.
Yeah,
So
all right, real quickly, I want to hit some earnings this week. Palantir reports after the close today, Monday. It's a $93 billion market cap company. It's up 140% on the year. This is a company expected to do $2.7 billion in sales, $3.4 billion next year. So this is not like a hyper growth story within the AI. This company has been, very, I want to say, promotional. The CEO of the company was on CNBC, very long interview the other day. He was not mincing words about a whole host of other things. They sell a lot of their services to the U.S. government, specifically the Defense Department. So when I think about, much of the generative AI trade, as we just kind of elaborated, it's really around these hyperscalers, these trillion-dollar, plus market cap companies. This will be interesting to me from a sentiment standpoint. The private move in the options market, about 13% on average. This stock has moved 19% the day after earnings over the last 4 quarters. So really want to hear what they have to say. The other name that's interesting to me on Wednesday is Novo Nordisk. We just talked about Lilly a little bit and that sales miss. So to me, when we think about these mega trends from a sentiment point, again, if they miss, this will be very interesting. I think the stock is de-risked for a couple reasons. It's already down 25% from its recent all-time highs, and it trades at a much cheaper valuation. So that's one I'm looking at. And Liz, maybe you can opine on this. It's not on the specific name, but Airbnb reports Thursday after the close, about a 7-8% implied move. But this is a stock that's unchanged on the year. Revenue and earnings growth expectations are about 10, 11%. So this is not a high growth company anymore. But it's from a consumer standpoint, what are some of these earnings that we're getting to? What are they telling you? If Airbnb, let's say, has a weak guide going forward, stock's expensive, expectations are not particularly high, on the revenue and the earnings standpoint, is this one of the ones where they would shoot first, ask questions later, and it would have to be a big beat and raise to get it going? And I guess I'm just curious from a market standpoint, how important is a guide up for a name like this?
From a broad market standpoint, I don't think it's all that important right now. But to your point about healthcare before, if you've got Lilly disappointing, if Novo Nordisk disappoints, some of that, when you link it together, becomes a theme. And we've talked about this in the consumer space, companies like Walmart and then Costco and Target. If all of those are saying the same thing, and if it's all negative, you have to assume that there's a theme going on in the space. So I think if you look at the travel and leisure space, Airbnb would be lumped in with a lot of those. So if you've got big hotel chains that are saying the same thing, or they're under pressure, or the stock is moving sort of the same direction. If you've got airlines talking about leisure bookings that are faltering, if you've got cruises that are talking about the same thing, then it becomes a theme. What the macro data has shown so far is that consumers are still spending on services. There hasn't been a huge pullback in that part of the economy. So I wouldn't expect there to be a big change right now. But if into 2025, we start to hear some of those companies linking together and saying, you know what, our demand is down, our costs are up, let's say oil prices go up, right? That sort of thing. Some of the input costs go up. I think then you have to take a step back, look at consumer services as a whole, and make sure that you're not overexposed to the place where people have decided to pull back their spending.
All right, last thing here. Over the last, I want to say, month or so, we've seen Amazon, we've seen Microsoft. They've done something that I don't think too many folks thought would happen anytime soon. They've struck these power deals with these, energy companies that are putting back online some of these nuclear facilities that, in 3 Mile Island, for instance, one of these reactors has been closed for 40 years. And, the thought that the energy consumption to run these data centers, is going to go off the charts. Danny, talk to me a little bit about this ruling from a federal commission that came out. I think you would call it, what do you call these things that come out on Friday afternoons?
Friday night dirties. This was a big one. Dirty, almost a dirty bomb if you want to throw nuclear into it, right? Friday night dirty. There was 2 Friday night dirties. One not so dirty was the change in the Dow components that NVIDIA is going to replace Intel, and then also Sherwin-Williams is going to replace Dow Chemical, not to be confused with Dow. I just want people to know, again, the Dow Jones is a horrendous way to monitor the markets. It's price weighted. It's not market weighted. As a matter of fact, NVIDIA is going in as number 22, just to put that in perspective, because of the price of the actual stock. So Just want to throw that out there. So the other thing that came out was the Federal Energy Regulatory Commission, FERC, basically told Talon Energy and Amazon, hold on a second, we're concerned about prices of energy to the consumer and availability of power and the grid to the consumer. So we've talked about this before, how these utilities, and Talon's an independent power producer, but still regulated by FERC, that these are regulated entities, right? And you're basically bringing forward all this potential revenue in the I space. And the biggest concern has been, can you generate enough power in general? So you saw Constellation Energy get hit, Vistra Energy get hit, and obviously Talon get hit directly on this, but they were leaking kind of late Friday, so to speak. So this deal, though, I just want to note is different than the other ones because this is tapping into an existing grid. All these other deals we've seen from Microsoft, Google, et cetera, have been basically to either build new power plants or not take power away from the existing consumer. So this will play out in courts. Obviously, they're still going to allow Talon to do, I think, 300 megawatts versus kind of the 480 they were looking for. But it's just a wake-up call, I think, in the sector in general, on the secondary plays, tertiary plays into the sector. Just know what you own. And when you own a utility that has a 0.55% dividend yield or 0.71% dividend yield like Constellation Vistra, understand that at some point you better be raising that dividend, which won't happen for years based upon these revenues coming in. So just be smart about it. Just a wake up call.
Yeah, and just to be really clear, I mean, Talon, Vistra, these stocks were up, 200, 300% off of their recent lows to start the year. And obviously they're coming off here a little bit. There was a huge second leg of those moves when Microsoft and Amazon started striking these deals. So again, an interesting kind of outgrowth of this mega trend. And we'll see if the regulators continue this sort of pressure on them. All right, guys, we covered a lot of ground. I think we have to say, strap in here a little bit because this could be one of the more interesting weeks of the year in the markets. Thanks so much, Liz Young-Thomas. Danny, we'll see you guys all later this week on Market Call and the On the Tape podcast.
I want to say one thing, and thank you. I want to say, if you're a company out there that wants to put out bad news, I would say Tuesday at 4 o'clock in the afternoon, your best time to throw it out on the tape. So that would be the time that I'd be looking for it. So,
all right. So maybe a Tuesday night dirty or two, Danny.
Yeah,
Boy.
exactly.
All right. See you guys.